we see what we can do and how we can overcome that. It will probably stay with us for a little bit longer. I always thought the word for March is Kabeja, the new name for PE, but it's apparently not. The word for the month is inverter. So maybe we should all get inverters. Who knows? Right. The global backdrop remains constructive for global assets, which includes property. However, as growth and GDP numbers are higher than expected, we run the risk of global inflation, and we've mentioned this in a couple of past sessions as well, which is not good for growth assets and maybe not property as well, but we'll see it. We'll try to cover some of that today. We've seen US bond yields rise yesterday ahead of Fed's first policy meeting. How much further can global bond yields go? We'll see, and what will the impact be on growth assets and the property sector. So hopefully Evan and Gareth can cover some of that today as well. First up is Evan from Seshvakile, which you're all familiar with, and he will be followed by Gareth Elson, CEO of Reitway Global. Both these managers eat, breathe, and live property. They're property specialists on local and global front. So you can truly say that they are these most or the most qualified people to speak to us on local and global property and what can be expected going forward. First up, Evan, thank you very much for joining us. It's always great to have you on these sessions. And for those of you who logged in a little bit earlier, we had a bit of a discussion already on some of the stocks being held by either Seshvakile or Reitway, so it might be an interesting conversation. We do encourage our audience, you know the drill. Any questions that you have for our speakers, please post in the chat room, and we'll try to get to the questions after both presentations. Evan, we've seen some very good recovery in the property sector over the past 6 months. Roughly about 21% over the past month, 8.28%, very, very strong month. And I guess the question from everybody is, can this recovery continue and to what extent? We look forward to your presentation with your views on SA property valuations and how that plays out in the Seshvakile BCI Property Fund. Again, thank you so much, Evan. We're really looking forward to your presentation.
Thank you very much. Okay, so is my presentation up and running?
I can't see it yet, no.
Okay, so
yeah, just maybe unshare and share again, it's fine.
Okay. You should be on it now.
It's coming up there, full screen, perfect. Good stuff.
Okay, perfect.
Thanks,
okay, so now I'm just bouncing through. You don't need to know about us. We almost 11 years in the making. 2 strategies, local and global, and with an AUM of 16 billion. And it's been a rough ride. The earlier years were relatively smooth. We had positive performance. It's great. But obviously in the last 3 years, from 2018, really calendar year 2018, all the way to 2020 have been 3 terrible, terrible years. And, we're coming out of that. Some of the correction is warranted, but it's still a much weaker environment. And we're going to speak through it. Firstly, the underlying fundamentals, the assets, and then we're going to speak about valuations. I have 10 minutes to speak, so, please excuse me if I go quite fast, but I think we need to cover everything just to get an overview of what's going to happen. So speaking about the markets, just to look at firstly, the rental collections, and this is a great positive. And I think this is some of the additional bounce was caused by this because in the last couple of months, we've actually had collections, rental collections of over 100%. And people will say, well, how do you get over 100%? Well, it's just because some of the, the lags of collections in earlier months where they didn't discount the rentals, but they said they delayed it to later months are now being paid back. And you are seeing much better collection rates, especially when it comes to the retail space. And that's very, very positive. And, we got to ask ourselves how much of that is coming through from the government support. But nonetheless, is that you are seeing what we expected initially. When I spoke to this audience, in call it March, April, it was exceptionally negative. Why? Is because we had no line of sight. We were, modeling on call it 9% with no collections, just on a worst case scenario. And we're so far from that number. So where the market was pricing, and fairly so because we just had no line of sight on what the pandemic would bring with regards to the extent and the duration of the lockdowns, now we're in a much better comparative position, not in a good position, but in a much better position. So if you look at the next slide, we see retail, and retail's been a mixed bag. It's a lot better than expected, but still, obviously, as a whole, we've seen several headwinds. But if you want to break it down in this graph you've seen there, it's been very interesting. So The lower end, more convenience malls have done much better. And you even seen, like, for example, Atterbury Value Mart, Bochabelo, which is more rural type center, Eastgate's Lifestyle, so not the shopping center, but more easy access type center and more home improvements, have done actually quite well. Year on year, they've actually seen growth in the trading densities. But the bigger shopping centers, the closed malls, the regionals and super regionals, the likes of Hyde Park and Rosebank and Eastgate, they've actually seen quite negative numbers because people are still suspect to go into closed malls. And also, people are buying less less discretionary items. So they'll go into a convenience and they'll go to the supermarket, and you saw ShopRite's numbers yesterday were superb because people are still having to buy the essentials, but people aren't buying, I said the middle market aren't buying the discretionary items to the same level as they did before. Well, that said, is that you look at Sandton City and they've done badly at all. And why is that? It's an anomaly we've seen there is luxury brands have done exceptionally well, up 28% year on year out of that portfolio. And why is because the high net worths who haven't been able to go overseas and spend a lot of money have been forced, for lack of a better term, forced to spend, in the local environment. So luxury brands have done very well. Groceries have, obviously done very well because people have been, like myself, eating a lot. You can't see the lower end of the screen, and I'm sure that's for a good reason. I've been locked up and eating quite well. And department stores, which are selling the more discretionary items, clothing, business wear, they've done actually quite poorly. And that's really been the breakup. If you look at the vacancy rates, vacancies have pushed up 2%, but that's really not that bad if you look at the bigger scheme of things. And generally, the general retailers or the majors have actually shown quite solid results. So retail, we were very negative because we had no line of sight in the initial stages, but now we are, relatively speaking, a lot more positive. If you look at office, and that's completely the other way around, initially we weren't as negative. Why? Is because unlike retail, where they could stop paying immediately, you couldn't do that in office. And that extension, as people are doing less business, as the economy pulls back, you've seen a much bigger weakness coming through in office. The rental reversions are still off quite a low base, negative 15%. And people say it's because people are at home, there's more work from home ideas. That's not the case. It's because of the GDP. Look at that top left graph there. The office demand is really a great reflection of what the economy is doing. And the one silver lining is that there's been very little new stock. On average, it's about 4%. And you can see now it's only 0.6%. So there's no new supply coming to the markets. But the problem is that the existing supply is still too much for where the economy is working at the moment. Vacancies haven't shot up if you look at the actual numbers, just a little bit above the norm. But to be very, very honest, it's maybe a bit of smoke and mirrors, because what that we call the gray space or the sublets, people are subletting, and if you look at that, the vacancies are likely a lot higher. And just to speak about work from home, is a bit of a argument within our office. I personally don't believe in it. I don't think the efficiencies are good. People speak about efficiencies and the ease of getting to work. Within South Africa, we don't necessarily have the infrastructure. We have all the downtime that we have now. And also think of it, when you get back to work, the densities, if you look at the bottom right graph there, have gone all the way from 600 square feet on average to 151. Let's call it 14 meters. Now, we aren't going to go to an office and be on top of each other. People wanted to make office space more efficient. That doesn't work. You're going to need more meeting rooms, because if you're going to have these kind of Zoom calls, you can't have it in an open plan office anymore. You need more quiet rooms. So I personally think, yes, there'll be a bit of a pullback in office because of work from home initially, but I think the big driver of office has to be the economy. We need the economy to turn around once and for all and be on a positive trajectory. Industrial, I'm not going to speak too much about it. It's been positive. It's really been efficiencies in the logistics and the supply chains as opposed to online. Online will pick up. There's no doubt. You've seen results across the board that online has seen massive growth, but we haven't seen that reflect into the logistics space to such a degree. But we do believe that that will be a future underpin. So that's been the best sector of the three main sectors. But the biggest thing to be speaking about is the balance sheets. And everyone was worried about the write-downs. If you write down the asset value, your loan to values spike. The initial rounds were quite deep, and we expected deeper, but the second round impacts. So now we've seen guys reporting again, they're being quite tight. So we haven't seen significant write-downs. It's really been a factor of lower income. If you look at the bottom left graph over there, as opposed to the cap rates expanding out too aggressively. And, you know, to be very honest, we expect to see more declines, but not to the same degree as the market and even ourselves were thinking, call it 6 to 9 months ago. And if you look at breach of covenants, we don't think that's an issue, even though some guys may be close on covenant breach. The market has been selling quite aggressively. I've listed a whole lot there. I don't want to go through it. Don't have too much time. But, you know, guys have levers. They can retain a lot of earnings as well. They've sold over in the last 24 months, probably now 25 billion rands worth of assets. You've had guys come to market and raise capital. You've had the likes of, you know, most companies really retaining 70 and 25% of their earnings in line with the redistributions. And then the likes of Redefine and Dipula actually retaining everything. So, you know, we do believe that these balance sheets can be repaired. And what we've done there in that right graph, and again, don't have too much time to go through all the details, but, you know, from block 1 are the guys that are already positioned best, where there's no need to even retain any earnings should they not want to. And you go through to the red block on the bottom right, where guys are really struggling, with the exception of EPP, which is not a REIT, and they can retain all their earnings. And we're actually quite positive on that. All the others would stay away from. We don't believe that they are necessarily going concerns. But if you look at the pink and the pink block, that is where a lot of the market is focused, where they have high loan to values, and how do they amend that? Do they sell or do they have to come to market? And if that's the case, there'll be some dilution. But again, the price is more than taking that into account. And Central and Eastern Europe, just to touch on that, obviously global within the local space is north of 40% of our underlying asset base. These are still economies, even though they've been hit, you know, by COVID, still economies that are delivering decent growth. Yes, you're seeing contraction in GDP, nowhere near what we've seen in South Africa, but we expect that to grow quite, you know, or bounce back quite considerably. Debt to GDP is much lower than the Western European counterparts, and the retail space per capita is much lower. So the supply, or we've seen the pain in Western Europe, is nowhere near reflected in the likes of Poland and Romania. I'm just going to pop on for a time with regards to our portfolio. We are still somewhat conservative because, yes, we are a bit more aggressive than we were, but we still want to be able to go to sleep at night knowing that the earnings are intact and the balance sheets are most definitely intact. And we underweight the likes of a Hammerson and a Hyprop. We still don't believe in the steep recovery in the higher end LSM retail. We believe that rentals will be cut quite aggressively and balance sheets will be put under further pressure. Just to pop onto the last slide. So our expectations for the year were 23.5%. We've done north of 10% at the moment. So we expect the rolling 12 months, and I always look at rolling, I'm not going to say the next 9 months. We expect around about 13% in the next 12 months. And that is still driven by growth with a very low base. We don't think that the environment is strong, but we saw huge cuts in the 2020 base. So we still believe we can get growth of circa 11%. Our forward yield as we stand today is about 8.8%, and our IRR is around about 13%. With that said, I open up for questions for the next minute that we have. Thank you very much.
Evan, thank you very much for that. Evan, can you maybe stay on the line until Gareth finishes his presentation? We can deal with questions afterwards. Great stuff. Gareth, thank you very much for joining us likewise. I can't see your presentation up. Yes, fantastic. Gareth, you've had solid returns for the past 12 months, but what amazes me really is that you amazingly ahead of the pack. You know, so I'm actually looking forward to see what you include in your portfolio. What you do is so very different to a lot of other global property managers, and why you lead by such a great mile and the outlet for global property. Thank you so much.
Thanks very much, Eugene, and it's great to be with everyone again. A little bit of a different situation, I think, to where we were a year ago, with limit down trading days. I think lots of sleepless nights. Still volatile in the markets at the moment, but definitely nothing like we were experiencing exactly a year ago. But yeah, I think we've done quite well through it. I'll just quickly go through the team. So yes, myself leading a very able team of Martin and Marius. So a small team, but we're very focused, and we, as you mentioned, we purely do global property, and that's what we live, breathe, and sleep every day. Our product range is based in South Africa. We also have offshore offerings in Malta and Australia, and we replicate a master portfolio across all of these. The only fund that would be slightly different would be the enhanced property fund that we have, which has leverage in it as well, and is technically classed as a hedge fund. A good year last year, currently a Morningstar 5-star fund in South Africa, Australia. We also have 5 PE fund info crowns in Australia, 5 Plex crowns in South Africa, and we also recently won the 2020 Raging Bull for 5-year risk-adjusted awards, which we are very proud of, our second one, and we hope to keep adding to that too through our returns. Our current exposure at the moment, we believe we have a well-diversified portfolio. We are active managers, so we are always trying to see ahead of where markets are potentially going to go to, but not being blinded by where the pack can be going with things at times. The bulk of our exposure obviously is to the US, which is the largest REIT market globally by far. Then we have substantial exposure to Europe, and that'll be spread across the continent, include everywhere from France, Finland, Germany. Then we also have quite a large exposure to the UK at the moment, China and Hong Kong, Japan a lot less at the moment too. So Japan is typically a very large part of most of the global indexes. We're a bit skeptical always on Japanese recovery and growth. We always look for growth in how we approach our investments. So Japan is something that concerns us at times. And then Australia is quite low at the moment. We exited quite a lot of our holdings that we had in Australia for the bulk of last year. We just had some very, very, very solid runs on those that we just thought had reached the target prices, and we're not seeing further upside. So we're quite happy to harvest and move on from there. Our sector allocation, most of our exposure is to the residential markets, and that will include a mix of housing, apartments, manufactured housing. Our next largest will be on the industrial side. Retail, we started coming back into, so if you guys remember last year, for example, this stage, we had just about 0 exposure to retail, the same with diversified and the same with office pretty much last year this time. So we've started adding slowly to it as the markets have started to stabilize and improve since the crash in March last year. But still, underweight on office, still underweight on diversified. And then large overweights would be on the specialized, which would be the data centers and towers, and also onto the gaming REITs as well. Our top 10 holdings, I'm not going to go through all of these name by name, but you'll see the bulk of these will be in our favored sectors, which are primarily on the industrial and residential side. And then also you'll see some exposure there, which we might have differed from even a little bit on Hammerson, which has been a good performer for us for the last month and a half, which has been good to see, and we'll see how long that continues. Our total return performance on a 3-year rolling basis is we outperforming the benchmark and all our peers. We're very proud of this, and obviously our aim is really to always deliver long-term superior performance. So at times we might have short-term blips where we might slightly underperform, but our aim is always to have a 1-year forward view and outperform on that. Again, I won't go through each of these items here, but it's just to demonstrate since inception of the fund and over the various periods is we have managed to outperform the index as well as our peers, and with slightly less volatility as well, which is something that we also work towards as well. Now, looking at the sectors and the market in general, so this is just looking, we do our own views also on how sectors are performing. A lot of our initial asset allocation process focuses a lot on where we see the various sectors moving, and that's really the starting point from where we go as to how we construct our portfolios. We have various indices that we look at, measure ourselves against, and we also construct ourselves. So a lot of the indexes will quite often include and exclude certain property types, because not all property types are REITs. Everything is a listed property, but not all the indexes will capture non-REITs at times. So and also a lot of the specialized names in the sector, such as data centers, often will not be captured by the indices too. So, we construct these two so we have a bit more of a broader view of where we see the markets going, tracking these, see how they perform. So having a look at on the left there, you'll see these are the global sectors last year. Obviously, the top performers, really unsurprising, would have been in your logistics and warehousing space, and also on your specialized, which would be your data centers and towers, primarily their data centers last year. Those performed extremely strongly, especially in the first quarter and second quarter, and then started to run out of steam towards the end. You'll see retail, not surprisingly, was the most heavily hit. It's actually, even though despite the big pops that we've seen from November last year, it's still trying to get back to level. Some of the companies have actually got there and have broken through. Quite a few are still under there, but you've seen as retail started to recover there, a bit more love going there versus industrial, which we're not convinced is actually the long-term correct approach. Having a look at this year, you'll see the leading sector is retail. As I mentioned, it's still working its way back to where it fell off the cliff. Industrial lagging a little bit, specialized lagging quite a lot. Again, we think not really the correct way to be looking at things. Office also probably reacting a little bit stronger than it should, as well as diversified. And residential really has been the solid performer across all the time periods that we've seen. Just looking at these commercial property price indices that we get from Green Street based in the US, these are primarily looking at US based properties. These are what they have seen based back to 2015, the various sectors and how we've seen those price indices move. Again, you'll see the strongest movement there in manufactured housing. So these would be prefabricated houses, trailers, etc. Not anything we have exposure to locally, but this has been a phenomenally well-performing sector internationally for almost 10 years now. And then obviously industrial, we've seen a huge amount of growth there over the years. Globally, it's just been a phenomenal performer, and we expect it to continue to do that. And then self-storage too. Having a look at the bottom there, again, not surprising to see more values the way they've fallen. Lodging, hotels, obviously incredibly hard hit by the pandemic, but starting to recover a little bit. It's also always interesting to have a look at the change in the private values as well. Pre-COVID as to now, obviously industrial has just really been firing on all cylinders, and we expect it to continue to do that. Very strong performance again also from self-storage, a sector that always does very well during periods of disruption, and it has continued to do that. If anything, we're probably a bit surprised as to some of the price movement that we've seen in apartments, and that we expected that perform a little bit stronger, but not surprised really by office and by retail, if you see that in the strip, and more figures there. What's more interesting for us always is having a look at where things are forecast to go in the future. The past is all great, but it's really is where are things going. Again, looking forward, this is a measure that Green Street has called RevPAF growth, which is looking at revenue per available foot, which captures basically rental growth and occupancy change over time. So very interesting here, looking at their views of the market to 2025. Again, they continue to see industrial being the strongest appreciator, same with manufactured housing, self-storage. And then, even though you've had strong recoveries there, both in lodging and retail and office, not seeing the type of growth that potentially some of the moves in the market might be at the moment. Yeah, I think last year, when we look at the way the markets moved past March, basically real estate globally got left behind a little bit. We think a bit unfortunately and unfairly, especially in some sectors. Yes, we don't think it made sense to be buying malls in March, but as we saw a lot of the drop-offs in things that were growing extremely strongly, especially logistics and warehousing and the data centers. So we do think, and we do see a lot of research viewing the spread that we're seeing between the values on REITs versus the S&P to be a little overdone at the moment, and we do view the sector as cheap. Obviously we now again have, just after surviving everything last year, we now get into the rising bond rates, bond yield market, where everyone starts to think, oh my God, you know, property is a bond, and when bonds sell off, we need to sell off property. This is something we deal with all the time as well. We buy into this to a certain degree, but properties are underlying businesses that reflect the economies below them. So this is a bit of work that we've come across, and we've carried on building on ourselves as time has gone forward. So what we basically track on this is how the property market reacts during times of increasing yields, how they underperform or outperform versus equities, and more importantly, what actually happens to REITs versus equities post these moves. So typically, not really a surprise to anyone, is as yields rise, is everyone starts to sell out of listed property. There's this panic, and then it typically underperforms. What then happens post that is REITs normally move into pretty good price ranges where they actually screen quite cheaply. They start to appreciate. They generally appreciate more than equities over that time as well, and continue to do that from the 180-day period to a year. Why is this? Our view is obviously there's many factors at play, but obviously in a time of increasing yields, it's normally an indicator of an economy that's actually starting to function a lot better, growth starting to come through. And when that's happening, that's a very good drive for the underlying businesses that make up the real estate that goes into the sector, where you start to see growth coming through, and that'll affect everything from retail through to office through to data centers. And that's why we're not really surprised by what we see post the sell-off. So for us, it's always, we know what's going to be coming. We know what we're going to be dealing with as yields start to improve. There are also certain sectors that we adjust our exposure to as well that actually do quite well during periods of rising yields. So we increase our exposure to that and structure the portfolio to take advantage of that while yields are hiking. As they start to stabilize and we start to see the sectors start to come back into favor, again, we then rotate into the other sectors, and that works quite well. Our outlook for the year, we're not viewing this year as becoming a nice, stable, calm year. It's going to be another year of volatility. We don't think it's going to be as volatile as last year, but never say never. The only thing guaranteed is change, and we'll certainly see a lot of that this year. We've definitely seen that during the first quarter for property. Vaccines have obviously changed the narrative globally. There's a long way to go. We've seen the UK doing extremely well on their rollout, the US too. Africa really is for what's been done so far might as well be zero, and the bulk of the world really is still following along very slowly. So it's looking better, but there's a very long way to go. With the new administration in the US, it's still, I think, viewed as a rough net positive at the moment. The increased stimulus that's just been passed should also be positive for the sector. And again, as I said, the US pace of vaccinations is just really proceeding extremely well. Global growth, though, while it's getting better, is still going to be tough. There's a long way to go. There's a lot that needs to recover. It's obviously encouraging as we see it looking a little bit better. But the important thing with all of this is just to remember that obviously not all the sectors are going to perform equally well. We still remain positive on logistics and warehousing, on the specialized sectors too, as well as residential, especially manufactured housing. And while there are spots in retail that are attractive, we think there are lots of value traps that you need to be very careful and nimble to avoid. But we do believe that the outlook for global REITs for this year is positive, and we think it offers value for investors. Thank you, and very happy to deal with questions.
Right, Gareth and Evan, thank you very much for that. Covered a tremendous amount of ground in a very short space of time. Gareth, I found that second last slide of yours was massively interesting. We actually do model for global inflation and bond yields on the rise. But maybe, Evan, if I can maybe just direct that question your way as well. Where do you see inflation, local global bond yields going, and the impact on the SA market?
You know what, it's like calling currency, to be very honest. You can't really, call that. We are pricing in for slightly high inflation. and not to get out of hand. And with that, that should help underlying cash flows. You have seen, and to be honest, locally as well, initially we were expecting, and I think the consensus was a long bond in South Africa, call it circa 9.1%. It's now pushed through, it touched on 9.8. I think at the moment it's sitting about 9.5, 9.6, and it's higher than expected. Obviously, that on a valuation perspective will pull back on valuations, but a little bit of inflation, if it's for the right reasons, will underpin a bit of rental growth as well. And I think that's probably more of a story in the US and globally as it is than it is in South Africa, because the inflation would be premised more on growth as opposed to being bought in.
Yeah, thank you very much for that. And I mean, despite that, I mean, your views still remain, you've made the points very constructive for the remainder of 2021 on the local and the global property front. And what we've picked up when we construct portfolios, I mean, we know for a fact that a lot of multi-asset funds don't really look at the global and local property sector. So for anybody out there, our audience, if you want to prop up your clients' portfolios with SA or global property, think Seshfikile, think Reitway, they are truly the experts. And both Evan and Gareth, you're very modest when it comes to your slides on returns. I really think you spend a lot more time on that because you've done a stellar job so far, not only in giving solid returns in the recovery period for our clients, but you are clearly heading the peer group average as well, or the rest of the pack. So thank you so much for that. I don't see any questions in the chat room. So with that, I'm going to thank our audience for attending. Looking forward to see you again on next Wednesday, the 24th of March. Remember, that's our session. That's a little bit longer for an hour and a half. We're going to cover local, global, equity, fixed income, and asset allocation and multi-asset funds. Should be a very, very interesting session with Anchor, Blue Alpha, Centaur, and Visio. So thank you so much for everybody joining. Gareth, Evan, thank you so much. You're doing a brilliant job for our clients. Always good to have you on the sessions. And we look forward to see you all again next Wednesday, the 27th of March. Tanya, Olga, the BCI team, thank you for setting us up. Always great sessions. Thank you so much.
Thanks.
Thank you.
Bye.